Right now, there is a Social Security change for 2026 that most retirees have completely overlooked. This is not a rumor or speculation floating around the internet. It is an actual update from the Social Security Administration that could directly impact your monthly check. If you are receiving benefits or planning to file soon, you need to hear every word of this video. I have spent over 30 years helping people just like you protect their retirement income. In all that time, I have never seen so many changes hitting retirees at once. The problem is that most of these updates get buried in government documents nobody reads. That is exactly why I am breaking this down for you today in plain, simple English. Here is what worries me the most about this particular change. Millions of seniors will not find out about it until their check looks different. By then, it could be too late to take the steps that might help you keep more money. So please stay with me for the next few minutes, because this information is essential. Let me give you some important context before we dive into the details. The Social Security Administration announced that roughly 72.5 million Americans receive some form of Social Security benefit. According to SSA.gov, the average retirement benefit in early 2025 was approximately $1,976 per month. That number is the starting point for understanding what is shifting in 2026. Every year, the SSA evaluates the cost of living adjustment, known as the COLA. The COLA is supposed to help your benefits keep pace with rising prices at the grocery store and gas pump. For 2025, the COLA was set at 2.5%, which was already lower than the 3.2% increase in 2024. Early projections for the 2026 COLA are hovering around 2.2 to 2.5%, according to estimates from the Senior Citizens League. Now here is where it gets tricky for your wallet. A smaller COLA means a smaller dollar increase on your monthly check. If your benefit is $1,976 and the COLA comes in at 2.3%, that adds roughly $45 per month. That sounds helpful until you realize what else is changing at the same time. Think of your Social Security benefit like a pie sitting on your kitchen table. The COLA makes that pie a little bit bigger each year. But Medicare premiums, taxes, and other deductions are like someone taking slices before you even sit down. What actually lands in your bank account is only what remains after all those slices are removed. The reason this matters so much in 2026 is that multiple deductions are expected to increase simultaneously. Medicare Part B premiums, income-related surcharges, and tax thresholds are all moving in ways that eat into your raise. Most retirees only pay attention to the COLA headline number. Very few people look at what their net benefit will actually be after all the adjustments. So let us get into the first major insight you need to understand right now. The Social Security earnings test is changing for 2026, and it affects anyone who is collecting benefits while still working. According to SSA.gov, for 2025, the earnings test exempt amount was $23,400 if you were under full retirement age. That threshold is expected to increase modestly for 2026, likely to around $23,800 to $24,000 based on wage index projections. Here is why this matters in real dollars and cents. If you earn more than the exempt amount, Social Security withholds $1 for every $2 you earn over the limit. So if you earned $30,000 while collecting benefits and the limit is $23,800, you earned $6,200 over the threshold. That means the SSA would withhold approximately $3,100 from your benefits that year. Many retirees do not realize this withholding even exists until it happens to them. They pick up a part-time job or do some consulting work, and suddenly their check drops. The good news is that the withheld money is not gone forever. Once you reach full retirement age, the SSA recalculates your benefit to credit you for the months of withholding. But here is the catch that trips people up every single year. The recalculation happens automatically, but it does not happen all at once. Your benefit gets adjusted upward gradually over time to account for the withheld months. Some retirees never even notice the increase because it gets blended into their regular payments. For 2026 specifically, there is another threshold you need to know about. In the year you reach full retirement age, a higher exempt amount applies. 2025, that amount was $62,160, and the SSA withholds $1 for every $3 earned above that limit. This higher threshold for 2026 is projected to land near $63,000 to $63,500 based on current wage growth estimates. Let me give you a real example so this hits home. Say you turn 67 in October of 2026, and that is your full retirement age. From January through September, you can earn up to around $63,000 without any benefit reduction. If you earn $70,000 during those months, roughly $7,000 is over the limit, and the SSA withholds about $2,333. The key detail most people miss is that this only counts earned income like wages and self-employment earnings. It does not count your pension, investment income, rental income, or withdrawals from your IRA. Many retirees unnecessarily limit their work because they think all income counts against them. Understanding this distinction alone could put hundreds of extra dollars in your pocket. Now let us talk about the full retirement age itself, because this is shifting for people born in certain years. If you were born in 1960 or later, your full retirement age is 67, according to SSA.gov. If you were born between 1955 and 1959, your full retirement age falls between 66 and 2 months and 66 and 10 months. Knowing your exact full retirement age down to the month is critical for 2026 planning. Here is why getting this wrong can cost you real money. If you claim benefits at 62 instead of waiting until 67, your monthly check is permanently reduced by about 30%. On a $2,000 full retirement benefit, that means you would receive only about $1,400 per month for life. That is a $600 per month difference, which adds up to $7,200 every single year. Conversely, if you delay benefits past your full retirement age, you earn delayed retirement credits. For each year you delay beyond 67 up to age 70, your benefit grows by 8%. On that same $2,000 benefit, waiting until 70 could boost your monthly check to roughly $2,480. Over a 20-year retirement, that extra $480 per month totals more than $115,000 in additional benefits. Stay with me, because what I am about to show you will surprise you. This next section covers a common mistake that costs retirees thousands of dollars. It involves how your Social Security benefit interacts with your taxes. Most seniors have no idea that up to 85% of their Social Security income can be federally taxable. The IRS uses something called combined income to determine how much of your benefit gets taxed. Your combined income equals your adjusted gross income plus non-taxable interest plus half of your Social Security benefit. If you are a single filer with combined income between $25,000 and $34,000, up to 50% of your benefits may be taxable. Above $34,000, up to 85% of your benefits could be subject to federal income tax. For married couples filing jointly, the thresholds are $32,000 to $44,000 for the 50% bracket. Above $44,000, up to 85% of your combined Social Security benefits become taxable. Here is the critical problem with these thresholds. They have not been adjusted for inflation since they were set in 1993, over 30 years ago. That means every year, more retirees get pulled into paying taxes on their Social Security benefits. The COLA increases your benefit amount, which increases your combined income. A higher combined income pushes you over these frozen tax thresholds. So the raise you thought you were getting actually triggers a higher tax bill. Let me show you exactly how this plays out with real numbers for 2026. Imagine you are a single retiree receiving $2,100 per month in Social Security, totaling $25,200 per year. You also have a small pension of $12,000 and earn $3,000 in interest from your savings accounts. Your combined income would be $12,000 plus $3,000 plus $12,600, which equals $27,600. That $27,600 combined income puts you squarely in the bracket where 50% of your Social Security is taxable. That means $12,600 of your Social Security income is subject to federal income tax. Depending on your tax bracket, you could owe an additional $1,500 to $2,000 in federal taxes. Many retirees get blindsided by this because nobody told them their benefits could be taxed. Now it gets even more concerning when you factor in the 2026 COLA increase. If your benefit goes up by $45 per month due to the COLA, that is an extra $540 per year. That $540 increase might push your combined income from just below a threshold to just above it. Suddenly, you could owe significantly more in taxes even though your actual spending power barely changed. There are legal strategies to manage this tax exposure, and I want you to know about them. One approach is to consider Roth IRA conversions, where you pay taxes now at a potentially lower rate. Roth distributions do not count toward your combined income calculation for Social Security taxation purposes. This strategy works best if you have a few years before you start claiming benefits. Another strategy involves controlling the timing of your income withdrawals from retirement accounts. If you can keep your combined income below the $25,000 single or $32,000 married threshold, none of your Social Security is taxed. Some retirees strategically draw down traditional IRA balances in their early 60s before claiming Social Security. This can reduce future required minimum distributions that would otherwise push their combined income higher. A third approach is to consider qualified charitable distributions if you are 70 and a half or older. You can direct up to $105,000 per year from your traditional IRA directly to qualified charities. These distributions satisfy your required minimum distribution, but do not count as taxable income. That keeps your combined income lower and can reduce or eliminate taxes on your Social Security benefits. Here is one more tax consideration specific to 2026 that most people are not talking about. 13 states currently tax Social Security benefits at the state level, though that number has been declining. States like Minnesota, Utah, and West Virginia have been reducing or eliminating their Social Security taxes in recent years. Check your specific state's rules, because the savings could be worth hundreds or even thousands of dollars annually. Now here is the part most seniors never hear about. Your Social Security benefit is calculated using your highest 35 years of earnings. If you worked fewer than 35 years, the SSA puts zeros in for the missing years. Those zeros dramatically pull down your average and reduce your monthly benefit amount. This is where the 2026 update creates a real opportunity for some retirees. If you are still working, even part-time, your current earnings could replace a zero or a low-earning year in that 35-year calculation. The SSA automatically recalculates your benefit each year you have new earnings. This recalculation happens without you even needing to file any paperwork. Let me put specific numbers on this so you can see the potential impact. Say you had 30 years of solid earnings and 5 years of zeros in your record. Those 5 zeros are averaging into your calculation and dragging your benefit down. Even earning $20,000 in 2026 could replace one of those 0 years and boost your monthly benefit. The boost might seem small at first, perhaps $15 to $25 per month in additional benefits. But over a 20-year retirement, an extra $20 per month adds up to $4,800 in total additional benefits. If you replace multiple 0 years over a few years of work, the cumulative increase can be even more significant. This is free money that many retirees leave on the table simply because they do not know about this recalculation. You can check your earnings record right now for free at SSA.gov by creating a My Social Security account. Log in and look at your earnings history year by year going back to your first job. Look for years with zero earnings or unusually low earnings that could be replaced. This 10-minute exercise could reveal an opportunity worth thousands of dollars over your lifetime. Now let me walk you through the Medicare Part B premium situation for 2026 because it directly affects your Social Security check. For 2025, the standard Medicare Part B premium was $185 per month, according to CMS.gov. Projections for 2026 suggest this could rise to approximately $190 to $197 per month. That increase gets deducted directly from your Social Security benefit before you ever see it. Here is the math that frustrates retirees every single year. If your COLA gives you an extra $45 per month, but your Part B premium goes up by $10, you only net $35. If your supplemental or Medigap premium also increases, your net gain shrinks even further. Some retirees end up with a net increase of less than $20 per month after all deductions. The hold harmless provision is supposed to protect you, but it has important limitations you should know about. This provision prevents your Social Security check from decreasing due to a Medicare Part B premium increase. However, it only applies if you are already enrolled in both Social Security and Medicare Part B. If you are new to Medicare, or if you pay your premium directly, hold harmless does not protect you. There is also the Income-Related Monthly Adjustment Amount, called IRMA, which can dramatically increase your Medicare premiums. For 2025, if your modified adjusted gross income exceeded $106,000 as a single filer, you paid more for Part B. The IRMA brackets are based on your tax return from 2 years prior, so your 2024 tax return determines your 2026 IRMA surcharges. This 2-year look-back catches retirees off guard constantly. Maybe you sold a property in 2024 or did a large Roth conversion that spiked your income. That one-time income event could trigger IRMA surcharges in 2026 that add $70 to $420 per month to your Part B premium. The total extra cost could range from $840 to $5,040 for just 1 year. The good news is that the SSA allows you to appeal IRMA if you had a qualifying life-changing event. These events include retirement, divorce, death of a spouse, or involuntary loss of income. You would file SSA Form SSA-44, which is the Medicare Part B Income-Related Monthly Adjustment Amount Life-Changing Event Form. This appeal can potentially eliminate the surcharge and save you thousands of dollars. Now, I want to share a hidden gem that the vast majority of retirees never claim or even know about. It involves the Social Security Administration's Medicare Savings Programs, which can pay part or all of your Medicare premiums. There are 4 levels of these programs, and income limits are more generous than you might expect. Millions of eligible seniors never apply because they assume they make too much money to qualify. The Qualified Medicare Beneficiary Program, known as QMB, pays your Part A premium, Part B premium, deductibles, and copays. For 2025, you could qualify with income up to approximately $1,255 per month for individuals. The Specified Low-Income Medicare Beneficiary Program, called SLIM, pays your Part B premium if your income is up to about $1,506 per month. Even the qualifying individual program covers Part B premiums for individuals with income up to around $1,695 per month. These income limits are expected to increase for 2026 when the federal poverty guidelines are updated. If your monthly income is under $1,700 as an individual, you should absolutely check your eligibility. The savings can be substantial, potentially $185 to $197 or more per month in Part B premiums alone. That is over $2,200 per year that many eligible seniors are leaving on the table. To find out if you qualify, you can contact your state Medicaid office or call 1-800-MEDICARE. You can also visit Medicare.gov and search for Medicare savings programs in your state. Each state administers these programs slightly differently, so income and asset limits can vary. Applying is free, and there is absolutely no penalty for checking your eligibility. Here is another hidden benefit that ties directly into your 2026 planning. The Extra Help program, also called the Low-Income Subsidy, helps pay for Medicare Part D prescription drug costs. If you qualify, this program can save you an average of $5,300 per year on prescription medications. For 2025, individuals with income up to about $22,590 and resources under $17,220 could qualify for full Extra Help. Even if you do not qualify for full Extra Help, you might qualify for partial assistance. The Partial Extra Help program has higher income limits and still provides significant savings on copays and premiums. You can apply online at SSA.gov or by calling Social Security at 1-800-772-1213. This is one phone call that could literally save you thousands of dollars every single year. Now let me give you your specific action steps so you know exactly what to do today. First, create or log into your My Social Security account at SSA.gov and review your earnings record. Look for zero earning years or low earning years that current work could replace. Also verify that your benefit estimate is accurate and reflects your most recent earnings. Second, check your combined income calculation to see if your Social Security benefits will be taxable in 2026. Add up your adjusted gross income, non-taxable interest, and half your Social Security benefit amount. If you are over $25,000, single or $32,000 married, talk to a tax professional about strategies to reduce that number. Consider Roth conversions, qualified charitable distributions, or adjusting your withdrawal timing before year-end. Third, call 1-800-MEDICARE or visit Medicare.gov to check if you qualify for Medicare savings programs or Extra Help. Also review your IRMA status by checking your 2024 tax return and estimating whether your income triggers surcharges. If you had a life-changing event, download Form SSA-44 from SSA.gov and file an appeal. Mark your calendar for October 2025 when the official 2026 COLA and Medicare premium announcements are expected. Let me recap the most important insight from everything we covered today. Your 2026 Social Security benefit is not just about the COLA number you see in the headlines. What matters is your net benefit after Medicare premiums, IRMA surcharges, taxes, and the earnings test are all factored in. Taking 15 minutes to review your accounts and eligibility today could protect hundreds or even thousands of dollars. If this information helped you see your benefits in a new light, I would be grateful if you subscribe to this channel. I release new videos regularly breaking down every Social Security and Medicare change that affects your retirement. Coming up next, I will be covering a specific Medicare enrollment deadline that catches thousands of seniors off guard every year. This channel is for educational purposes only and does not constitute financial or legal advice. Always verify directly with SSA.gov or Medicare.gov.